Thank you very much, Philip. Yes, it's a great pleasure to be here, a great privilege to be here, and wonderful to have read beforehand, slightly daunting, the description of you and your background and so on, and indeed talking to some of you over lunch, I feel even more daunted. So I'll come in with humility here, because a lot of what you're going to hear from me, you'll have ideas on, certainly, but I want to engage you in that and promote a discussion. I was a partner in one of the big City of London law firms, Slaughter and May. I retired a few years ago. Then I got involved with Michael Schluter, and some of it turned upside down. His relational thinking turned upside down what I practice, in a sense, as a corporate lawyer. I did M&A work, capital raising, restructuring, insolvency, a wide variety of reorganisations. And of course, the relational concept applying to companies, as we'll see, turned some of that on its head slightly, and it challenged some of my thinking that I'd adopted and accepted during my practice. So it was an interesting mixture with me, with my legal commercial background, working in pure city background, working with big corporate companies, big corporates, and Michael with his relational, obviously Christian approach of putting all that together was very interesting and challenging. I should say, to start with, there's a salutary guidance to anybody speaking here. First of all, you've got the hourglass that side, and then you've got the sevens. I know why those sevens. It's 7 times 70, but they look like Zs, don't they? So you can ziz while you're asleep. So if you feel like that, you're obviously allowed to do that. So that's quite understood. Anyway, since retiring from legal practice, I've worked with Michael. I've worked on a history project with our family music business in Liverpool, which we had many years. I wasn't involved in it, but I'm writing a history of that. A lot of Christian and other charitable work. And I'm very pleased to welcome Ling here this afternoon. Ling and Patrizio from the Judge Business School. They're doing an MBA course. They're working on a particular project and what I'm going to be talking about this afternoon. So it's very nice that Ling can be here and to hear the discussion. As part of my practice, I worked on professional committees looking at new company law as it came through, and just before I retired, I was part of an international group who advised the South African government on company law. So I've had quite a wide perspective, not only from a practice point of view, but looking at new law from a more of an academic point of view. This is the paper that Philip mentioned, the report. I think there's only 1 or 2 spare copies here, but it is on the Relational Research website, as well as another article I wrote on the same subject with somebody called Arad Reisberg, who is a law lecturer at UCL. He's now a professor of law. He's head of the legal department, legal faculty at Brunel University. So that's on the website. Indeed, he asked me to mention that he's written a piece on overnight for something called Conversation. I don't know what that is. It's a website, I think, which is coming out next week on Theresa May's announcements. And I was working on it with him overnight. There's some quite interesting stuff, which I should have here, but I haven't, that she announced about, and John was alluding to it, about moving away from individualism to sort of social interest, but also an article she wrote in the paper in the Times the other day as part of her pitch to be leader of the Conservative Party. About a quarter of it was about business practices, which is quite interesting. I'm going to mention 1 or 2 of those. And it does open the door, as John was saying, open the door to potential for us to be talking, racial research, talking about company reform and how we can get our message in, because it is echoing a number of the relational aspects I'm going to talk about. Now, I thought we should start at a very basic level, and these are things you'll know about. Somebody said to me the other day, he was giving a talk in our church about Christian thinking and social change and how Christians should live in society, which is sort of in society but not of society. And I went up to talk to him afterwards because he knew Michael Schluter, and I talked about some of his talks. And he looked me in the eye and said he was giving a talk to Ernst & Young in a few days' time, and he had to talk about what is business. And he said he didn't know about business very much, so it was impressive he was going to give that talk. So he said, could I send him an email with a few thoughts? So these are the few thoughts. Now, you will have rather more sophisticated thoughts on this, no doubt. But I thought it was a good start, because what I'm going to talk about is reforming company practice, corporate practice, and some of the very unattractive practices which have been adopted by companies over the past years, perhaps 10, 20 years, when corporate behaviour seems to have become egregious in some respects. And I'll explain the background to that and why it is. So I suppose the sort of a purely capitalist approach would probably say, and no doubt you can challenge me on this, that actually business is to make money, to earn profits. And then that money is obviously used in the business to pay debts, to pay employees, to contribute to society in the form of taxes. And then in theory, I think the capitalist theory is the people who own the business, who set up the business, make a lot of money, and it trickle-down effect into society. Now, we know that doesn't really work, does it? Look at Philip Green and BHS, if you know about that, where he sold BHS, a retail company, for £1, leaving a vast amount outstanding on the pension fund. Meanwhile, he and his wife are building a new yacht costing £100 million. So that's trickling down in a rather narrow sphere. I think the shipbuilders would be pleased, I suppose. So that approach, in some respects, seems to be flawed. I think the capitalist model is fine in a sense. There's no reason not to make profits, but it has to have the other elements of working, contributing to society. Another way of looking at it is a group of people get together. What's the purpose of business? To work in an enterprise, to provide, to manufacture goods, provide services to benefit society. Now, these may be goods and services that we need, food, drugs, whatever it may be. They may be things that we don't need, but we think we need, luxury items. And obviously, depending on which country, which continent we're talking about, some of them are more necessary for survival than others. So that's another sort of simple way. And then the development of the business flows out of that, but the focus is on what the company's doing. And it's certainly startups I'm engaged in, I'm investing in, are looking at a particular product, and they're working out how to sell the product, and their focus is on that rather than the broader social perspective. Then another way of looking at it is that this is a group of people who are working together. They set up an entity, maybe it's a company, I'll come on to that, and therefore it's actually a community of interests working together for the benefit of all stakeholders who are engaged in the business and also wider society. By stakeholders, I mean obviously people who own the business, and that's become the focus in many respects, but also employees, suppliers, customers, the local community, regulators, banks, lenders, and society more generally, for instance, taking responsibility to pay tax and not to avoid tax. So they're, as I say, working together in the benefit of all stakeholders. Now, if you get that right, we argue, and you understand what relationships mean, it's constructive, it's positive, it's working together. Obviously, difficult business decisions have to be made. But if you get that right, we argue that everything else follows, and that what I'm going to say, I hope, will make you realise that. So we're not fighting for what we can get out of the company, which tends to be the case. People are doing the hardest deal they can on the contract, trying to get the last ounce of money, whatever it is, dollar or pound, out of the company, and looking at it in financial terms. It's not fighting for that, it's actually working together and putting thoughts together and generating wealth and success between them. That is the relational approach, basically, and I think in many respects we've lost sight of that. So you think about what you can gain from being an employee of a company. It gives you a job, it gives you salary, it gives you a pension, if there's a proper pension fund. It provides status, doesn't it? A job for yourself, for your family, for your friends, people you meet. What do you say when somebody says, "Who are you?" Do you say you're a Christian? Do you say you're a mother or father or son or a daughter? Or do you say, "I'm doing a PhD," or "I'm working for Amazon," or whatever it might be? It's an interesting question, that, isn't it? Very often I find people, and I'm afraid I fall into this trap, identify themselves by their work, or in my case it's my past work, although I do tell people about relational companies rather a lot. And then all the sort of social side, but also the promotion opportunities in companies as well. And through enterprises, we can help other people develop businesses if they're suppliers to the company. Now, having said that, what are these entities we're talking about, the business entities, having looked at what they might be for? Well, first of all, you've got the sole trader, the individual who could be somebody just running a consultancy business for IT, or it could be the local plumber or the local electrician. A lot of people still work as sole traders, and obviously they have complete responsibility for their actions. They'll make the decision. If it goes wrong, they pay the price, morally, legally, and financially. They are personally liable. In the same way you have a mortgage to buy a house, they've got personal responsibility for that. They would have to, in this country, prepare accounts, obviously, because there's tax issues. They wouldn't need to file any public documents, so nobody knows about their business unless they agree to tell people. Another structure is the partnership. Now, we have what I call the traditional partnership, which is under the Partnership Act 1890. My firm was a traditional partnerships. That's a group of partners getting together. They own the business. They jointly take the decisions as to how the business runs. But they have personal liability. If something goes wrong, say a professional services firm, these could be accountants, lawyers, architects. Those are the sort of traditional way that people get together to form a partnership. If something goes wrong by negligent advice, say, and they're not covered by insurance, they will be personally liable. So they're putting their lives, their families, their house on the line for the partnership. That would seem to be rather tricky, especially for accountants, because if anything went wrong with companies, people turn to the accountants. So there was some legislation introduced here in 2000, the Limited Liability Partnerships Act, which basically makes the partnership more of a legal entity and contains the liabilities and losses, and the individual partners, subject to a limited number of exceptions, don't have liability. So it's moving towards, rather intriguingly, towards a company structure. Then, of course, we have companies. I'm doing this fairly briefly, but you'll know a lot of this. You can have private companies, public companies which aren't listed, and listed companies, listed on the stock market, wherever it may be, or several stock markets. People tend not to have public companies. There's a particular distinction. So we're just talking about private and listed, really. Now, you can get variations of private companies. Very often in a startup, say, there'll be a limited number of shareholders. There will be owner-managed. So the people who set it up, people who run it, are the owners as well. So that keeps them taking the responsibility. You can have employee-owned. There's a lot of chatter in the press about the benefit of employee-owned businesses. I think it's slightly misleading, the expression, because John Lewis over Arup, the big engineering company, Mr. John Lewis and Mr. Ove Arup, a Norwegian, who's written a very interesting paper about it, very generously, in a sense, put their shares into a trust. So the shares of those two entities are held in trust for the employees. So the employee doesn't actually say, I want to sell my shares. He can't sell the shares. They're in a block there. But the benefit is they're not answerable, those companies, to outside shareholders, as listed companies are. So they feel more engaged. If you to John Lewis, those of you who know John Lewis, you go out when you're buying something and say, did you enjoy your bonus this year? The point is they get the same percentage of bonus, whatever level their company are, depending on the level of profits. So obviously the different amounts, but it's the same percentage, and that engages them. So that's a positive thing. Then you have family companies. My family had a business in Liverpool from 1840 to 2002. I wasn't in it, but I'm writing a history of it at the moment. And just a small point, they manufactured pipe organs and they sold guitars. They provided 3 of the Beatles with their guitars that have claimed to fame. But just extraordinary statistic. This is sort of loyalty, and family businesses passing the business down from generation to generation, taking responsible attitude to their employees, to the local community, is that when my father was celebrating his 50 years with the company, this is quite a long time ago now, I've got the menu, the dinner. This is a company that only had about 300 or 400 employees. I think it was 39 other people had been there for 50 years, and about 130 had been there 25 years. You hardly got a tie when you've been there 25 years. You just about got a clock when you've been there 50 years. And it didn't pay very much, I don't think. But they just got that loyalty, that engagement. Now, you can have, as I mentioned, bigger private companies, like I mentioned BHS, that Philip Green, when he sold it for £1, he sold it on with a pension deficit of £571 million. And of course, that's all come home to roost now. It was a final salary scheme, so it's now gone bust. So what's going to happen to those poor pensioners? So that's another example of poor company behaviour. Now, what then happened with the growth of companies, it led to companies wanting to list on the stock exchange. They wanted to expand their business. If they were a manufacturing company, property development company, a drug development company, they'd need more capital. So then they do an initial public offering on the stock market, and they can raise capital through that, and then the owners, the previous owners through the private company structure, can realise part of their investment. Now that, of course, leads to share dealings, which I'm going to come on to in a second, and what's gone wrong. That leads you directly into what's gone wrong, but you need to bear in mind those different structures. Now, we're talking about social reformers. I was told to talk about social reformers. So if you look at some private companies in the past, in the 19th century, you get the great names like Cadbury Brothers, Roundtree, who used to be one of my clients, and Lever Brothers. If you go to Port Sunlight in the Wirral, which is where I come from, you see the village which was built for the workers. And these are jolly nice houses. They're sort of terraced, they've got very nice gardens. You can buy and sell them now because they don't have their company base there anymore. It's Unilever now, of course. And there are restrictions. They're protected buildings, so you can't develop them. But that was really enlightened. And if you go to York, you see the Rowntree Theatre, the Rowntree this, the Rowntree that, and the same way that the Cadburys looked after their employees. So that was really sort of paternalistic capitalism. Sure, they made money, but they put it back into society, looked after society. Now, what's gone wrong in the corporate world, this is what I want to focus on, then say what can we do about it, because I think we can all be social reformers. First of all, in the middle of the 19th century, limited liability was introduced, and that's when people wanted to invest in merchant companies. It started roughly the same time here and in the States. But they didn't want to have liability. You had the original partnership structure or structure whereby an investor would have liability if something went wrong, if the ship went down. So they, amongst much muttering, in the debate in Hansard, it said that it would be the end of any moral standards in the company world. And as with many things Victorian, there was an awful lot of truth in what they said. So limited liability meant that the company was there as the entity. That was the company that traded, that owned the assets, it took on the debts, it had the liabilities, and if something went wrong, it would go bankrupt, it would go into insolvency. But essentially, again, subject to certain exceptions, the liabilities had to be met out of the company's assets. So if there weren't enough, the third parties, the other stakeholders, the creditors, would lose out. But the shareholders stood above it, and they were protected, and that was the understanding. Now, what happened then, of course, that the share markets with listed companies started to develop and trade on their own. So as you know, you get all these sort of weird and wonderful contracts for differences, shorting mechanisms, artificial structures for buying and selling shares, investing in sort of synthetic structures as well, where the shares aren't actually bought and sold. But they became a financial commodity, the shares, and that applied to debt as well, but we're looking at shares for the moment. And it meant that it was almost like betting. You could buy shares, hold them for a short time or a long term. There are long-term shareholders in listed companies, but sometimes people hold shares for a sort of nanosecond. The statistics are staggering, depending whether the share price goes up or down. There's one case in the States, wasn't there, where somebody got some software and they were trading on the time difference between New York and Los Angeles, I think it was, because there was a price differential in Los Angeles and they could buy the shares in New York. And then it went up there and they just made a fractional turn, but do enough of those. I mean, that was share rigging or effectively taking advantage of the market. So what happened was you got these commodities being traded in a purely financial sense. And the shareholders then, what's happened is they take virtually no interest at all in what goes on in companies. What you read every day in companies all the time at the AGMs is complaints about directors' remuneration packages. No proper engagement, just complaining at AGMs. But it meant that the directors were delegated powers to run the company with no control by shareholders. Now bear in mind, this is the concept that a couple called Burns and Means, I think it was called Burn and Means, in the States in the 1930s said you have a situation where the owners of the company, the shareholders, don't manage it because it's all delegated to the directors and there's very little liaison between them, and yet the managers of the company, the directors, don't own it. They may have a limited number of shares. So you've got a huge gulf there. And the directors, essentially, in their own fiefdom, as far as they're concerned, they're running those companies to make money. Now, why are they doing it to make money? Because we, as shareholders, through our pension funds, through our own investments, we as society, there are obviously sovereign wealth funds and others, we don't realise this, but through our investment funds that we put our money into companies, we're telling these companies they've got to earn money for us. So it's become focused on, and we all know this, short-term, continuing financial return. So you've got a situation where you've got, as I say here, one of the politicians called it ownerless companies, absentee landlords. The absentee landlords, because they have very little engagement with what the directors do, as long as they get a financial return. If something goes wrong, they very often don't engage with the directors, they just sell their shares. So there's no continuity, or very little continuity. And as I say, no interest in what actually goes on, and it's a disparate group. So that's led to all sorts of problems. and these are summarised here. The short-termism. Now, there's so many examples of this. Every day you read examples. The Volkswagen scandal, which you read about, falsifying emission scales. Tesco, where there was some fiddling of figures. I read something from Tesco the other day that they were, for their results, their quarterly results, they have to have increasing profits. So apparently they were telling lorry drivers to keep driving around the M25, not to deliver new goods. Otherwise there will be a liability. That would increase the liability in the accounts and the cost in the P&L account. And they were told to ignore stolen food for stolen products for a while before the results. So obviously that would show as a loss. But if they ignore, it's been shoplifted, they could ignore that for a while. And they were told they had to put up prices just for a short time. Apparently you can put up prices in supermarkets for a short time without people realising. So they do that for a week or two before the stock take, because that would obviously appear as more valuable in the accounts. Now, my theory is, and I don't know if this is right or not, that these people who are doing this, middle management, were not fraudulent, were not knowingly, well, they were knowingly committed a crime, but they weren't doing it because they wanted to. They were told by the senior management of these companies they had to improve the profits the whole time, and this is the way they did it. They fiddled the figures. And then say, this is us, through our shareholders, demanding these returns. Do you know that in the 1970s, only 10% of profits earned by companies were paid out in dividends, and now it's 60 to 70%. And that means that money isn't being reinvested for research and development in these companies. I mean, you know this. And that means that there is not proper development for the future of these companies. It's all part of short-termism. And what does that mean, of this demand for financial return? It means the cost is borne by the other stakeholders. So the pension funds is starved, there's some figures which I haven't got here, of the amount outstanding on pension funds in the UK. I mean, it's absolutely stunning. Of course, it all depends on the assumptions when you value a pension fund. But and it means that they're limiting the amount they pay to the employees. We've now got a living wage here rather than minimum wage, but people should be paying much more than that. Do you know, a few years ago, there was a survey done by a trade union, and they discovered that 60% of Sainsbury's, one of our big supermarket groups, Sainsbury's has this image of a family company. It isn't a family company anymore. It was sold out to the stock market. 60% of their employees were on government tax credits. That means that we as taxpayers, well, not necessarily all of you, but me, we're subsidising Sainsbury's because they weren't paying their employees well enough. Egregious behaviour. Now, increasing pay differentials. This is something I used to think this is market forces, but no, it's got wider and wider and wider. So what does it say to someone working on the supermarket till in Tesco, one of the supermarkets, who has a stressful job, you and I coming up, dumping our stuff, demanding that they get it right and challenging them afterwards, and they've got a queue of people huffing and puffing behind them. What does it say? They say they may earn 10,000, maybe slightly more than that, when they know that the senior executives are earning 1,000 times more than they are. What does it say to them about their value to the business, their dignity? And then there are lists of companies every year. We have the shareholder spring when shareholders come along to the AGM and object, but they never get enough voting to turn these packages down. BP, Weir Group, Barclays, Reckitt, WPP, Burberry, just a few I took out of the paper the other day. Now there's reasons how that's grown, these pay differentials, but I won't go into that. So we talked about treatment of employees not being paid properly, not being engaged, these stress levels. It used to be back problems, which is the difficulty at work. The biggest reason now, I understand, people are off work is due to stress. They have redundancy programs and don't replace people, so the remaining people have to work harder. 0 hours contract. Some of them, you're supposed to be an employee. I think this is the way they keep the unemployment figures down, is you have a contract which says, yes, you'll work for us, but only when we want, and we'll only pay you on an hourly rate where you come in. So you hear stories of people going into work, and so there's no work for you today. They have to go home again. They're not paid for their transport, and they're not paid anything, and yet they're not allowed to work for anybody else. Now, what does that do to incentivise people? There's no bonuses. Pay levels have been kept low for so many years. And of course, all the research says that if you respect employees, incentivise employees, pay them properly, have them share schemes, productivity will go up. And what's the thing our government keeps talking about is our poor productivity. And then suppliers, I mustn't go on about this too long. Do you know that to suppliers to small and medium-sized enterprises, I think the current figure overdue in breach of contract by large companies is £32 billion. Now, what does that do to the cash flow? You know the point. The small supplier may just have one big customer, strawberry suppliers to Sainsbury's or somebody. What does it do if they're not paid on time? Well, they just go bankrupt, don't they? So, and then people, when you talk to people, extraordinary things, you read this in the paper as well, that the big companies demand money from suppliers supplying goods for, say, where they display the goods in the supermarket. You get the end of a counter thing, whatever they call, that's a special spot, isn't it? And you have good, and apparently the supplier has to pay to go there. Then Majestic, one of our wine supply companies, demanded from their suppliers extra money to pay a new warehouse. They said, why should we pay you for a warehouse? Anyway, a lot of arguments there. Then responsibility to society, not paying tax, the obvious one. Starbucks, Amazon, Google, companies should be good corporate citizens. And I have found, talking to people about this, particularly in the city, there's a good deal of complacency about all this and lack of engagement by the public because they don't understand how companies work, what the structures are. And it's interesting that when a company like Marks and Spencer announces its results, it's on the national news. What do they say? They don't say Marks and Spencer has taken on so many new employees, Marks and Spencer has opened new branches, and Marks and Spencer is now exporting to somewhere. No, Marks and Spencer's profits are up or down. It's financially driven. And actually we shouldn't really be interested in that, should we? Now, how do you address this? Now, this is the flaws all the way through. They're all question marks. The last one is the right answer, just before you get there. What do you do? And this is one of my mantras nowadays. This is the private sector. These companies are owned by people in this country, institutions, people abroad, a lot of it overseas investment, sovereign investment fund, which are very responsible. And yet we do it by legislation. The Companies Act that I was quite involved in 2006 when it came through one of the professional committees, it's the longest statute that we've ever had in this country on company law. And you get regulation. A lot of it is EU regulation. We may be getting rid of a bit of that for a certain act we did the other day. There's UK regulation. Then you have code. You have the corporate governance code. You need that. That's great. It's all about appointing auditors, non-executive directors, but it's a bit box ticking, really. The chief executive can't become the chairman, all that sort of thing. Then there's another code called the stewardship code. They focus on the relationship between the company and shareholders, not other stakeholders. There's no reference to other stakeholders. I think that the private sector should regulate itself. It should be up to us as shareholders to say to the directors, not to come along to the AGM and say, you shouldn't be having this pay package and 40% say no and the directors breathe a sigh of relief and carry on. We should be engaging with the companies beforehand and getting them to see they should be more responsible. Then you've got CSR, the famous CSR. Now, I have to admit, I was always slightly sceptical about it, so you know about CSR, that it's fine, don't disagree with it, but companies have CSR departments, they produce CSR reports, and they fund local projects, local schools, etc., give people time off to work in the community. That's fine. But it's now, what's his name, John Brown, who's chief executive of BP, who's written a book called something or other, Engaged Capitalism or something. These other people are doing this, slightly discredited it because it's done more for publicity than real benefit. Then there's ethical standards. You get these, I've talked to some of the ethical groups that talk about trust, transparency, honesty. Well, again, that's fine. You need that, obviously. Then you get ethical funds, which are a little bit suspect sometimes, non-armaments, non-tobacco, and you look around and see maybe it's not as simple as that. But what we're saying is, finally, that actually what you want to do is to get to the heart of the way the company operates. And you want to put relationships with stakeholders at the heart of company decision-making and operations, and not the heart of the company's decision-making being financial return and getting the best out of the other stakeholders. It should be, all stakeholders' interests should be looked at and developed for the benefit of all. Not to say you don't make difficult company decisions, you'll have to do that. So that's the beginning. Now, at the first bit there, now, this is now being recognised. The International Integrated Reporting Council, which I know some linguists telling me before, some companies now adopt. This is the triple bottom line reporting, and we've had a lot of discussions with them. And reporting on financial, environmental and social, and they recognise the value of relationships with stakeholders. Andy Haldane, who is amazingly influential, and Michael and I met him, he's the chief economist at the Bank of England, and he makes some very interesting speeches which touches on this. He said in a speech last year, May 15, the most straightforward way of tackling embedded stakeholder externalities is to have those stakeholders' interests weighed explicitly in the objectives and decision making of the company. In other words, don't just look at shareholders' interests, look at all stakeholder interests. Now, in the Corporate Governance Code in South Africa, the King Code, they recognise the value of stakeholder interests. And you have to report in your annual report and accounts on the strength of those relationships and how they develop those relationships. So it's focusing, as I say, on relational, not financial capital. We say if you get the relational aspect right, the financial results will come. And we say that if you get that right, you have engaged employees, you have suppliers who are encouraged by being paid on time, by perhaps sharing IT with suppliers to encourage them how to develop their business, listen to customers more than companies do, and work with banks, work with the local community, then we think that would increase, obviously, responsibility of the company to society, but increase competitiveness, sustainability, productivity, and profits. Now, what are we doing about this? So many people talk about this, but we don't know what we're doing. Now, this is a project which we're working on, as I mentioned, with Ling and Patricio, who are doing their MBA at the Judge Business School here in Cambridge. And we developed this idea, which is described in this book, of having a relational ratings agency, not another rating agency, they say, like credit rating agencies. But what it does is measure in an independent, objective, verifiable, sustainable way the level of relational ethos shown by listed companies. Now, it means that we set out what we call a relational business charter. It has 10 principles, which are summarised there, which I won't go into, but it covers the areas I've been mentioning. For instance, AGMs. I've been to so many AGMs, which are a complete waste of time, where the directors, I was telling someone before, troop onto the stage after a board meeting, all the shareholders sitting down there, they ask questions. Even one question at one AGM is, instead of giving us a cup of coffee, can we have lunch, please? Then they ask a few questions, and the directors troop off, and they have a very nice lunch. Fortunately, they ask the advisors, so the bankers and the accountants, so that was all right. But what I think is you should have quarterly meetings. You should have them in different parts of the country, depending which country you're in. All this applies in any country. You should have them in different parts of day, different times of day, because so often AGMs, it's the pensioners come hobbling along. I assure you, that's what happened with walking stick. It's a day out, which is fair enough. But if you had it in the evening, you get more engagement from other people, working people. And you should have breakout meetings. You could have a separate meeting on the accounts with the finance director, HR with the HR person, communications, and you could have, there'd be a relationships director, because you go and talk to the relationships director. And you actually get engagement. You start getting shareholders taking some interest and responsibility for what happens. And it's easier to hold the directors into account. If you look someone in the eye, this is part of the relational communication, you trust them. You get a sense of trust and confidence in the person you're dealing with. That's one example. Then you'd have incentivise long-term shareholdings. We talked about short-term shareholdings by awarding additional shares if you hold the shares for, say, 3 years. Limit pay differentials. We say 10-1. Look after employees. We talked about pay employees better, engage them, listen to them, incentivise them, look after suppliers. Do you know, we say in our paper that instead of companies paying 30, 60, 90 days, 120 days I've come across companies paying suppliers, that Waitrose the other day announced they were going to pay their small suppliers in 7 days. And that's what we say in our paper. So there we are. As John said, sometimes these things can work. You don't quite know whether it's us or not. I doubt it is in our case. But anyway, but actually more important than saying 7 days is, will they actually pay them on time to help with their cash flow? Then we're worried about debt. So we want to limit debt to once times capital reserves, basically, but that's all explained in here. Wider obligations to society. Companies should pay tax on the profits earned in a particular country, and they should become good corporate citizens. Now, those are set out in the relational business charter, which is in this paper and on the website, then the rating agency would measure, would assess the extent to which the companies comply with those principles by looking at published information, report and accounts, CSR reports, basically. Then the idea is they would go and talk to the companies and say, look, we've done this, particularly companies which feature well. We've tried this with supermarket groups here and supermarket groups in South Africa, and Ling and Patricia are just starting it with some other companies now. You go and say to these companies, look, you feature pretty well here, and we think we can explain why this would be attractive if people knew that you behaved in this way, because all these things we're talking about are things where the public is concerned and the public can take an engagement. And then if the companies can fill in some of the gaps, one of the things is, does everybody have a day off every weekend? Well, that's not explained in report and accounts, but they could then announce, yes, that is the case. Then we come up with a mark. We've done it out of 100. There are 10 questions, so it's 10 for each. Or we could have a kite mark. Then the idea would be, if we get this thing set up, it has to be independent and it has to have respect in the corporate company's eyes and in the public's eyes. And then these results will be published, and then people can decide whether they want to buy goods there, buy their services there, or invest in those companies. Then we could have a relational investment fund where you and I could invest some of our money in a fund which invests in these companies. And obviously it's not black and white. Some companies may say, well, our pay differentials are 50 to 1 at the moment, but we're going to work now towards making it towards 20 to 1, which is what we're saying. So you get regard for that. You get some reflection in the mark, in the kite mark, and then obviously the following year the comparison of what was happening the year before. So this would be another website that people could look at, and we're trying to work out who would use it. Is it open to everybody? Could people buy some of the information? But that's all part of the development, some of the things that Ling is looking at. So that would be how we could measure and how we could report. So the final one is this is social reform. Now this is what we can do, and people don't understand this part of it. I mean, you understand a lot of this stuff, obviously, of how companies operate, but the public don't understand. They read the paper, they think it's another world. Banks apparently think that as long as they comply with the regulatory requirements, that's all they need to do. They don't realise that the public have the most extraordinary disdain and lack of trust in the banks, given what happened in the 2008 crash. And we've lost the whole idea of relational banking. Obviously, nobody deals with their personal banker anymore. They keep closing the branches, and how many of you bank online? Probably all of you, don't you? So, and you've got no relationship with the bank at all, and yet that's somebody who's looking after your hard-earned money. And you're trusting them to invest it and hold it for you safely. So that's the first point. We need education. I mean, you don't need education. You're getting education. But people have to understand that we need informed articles in the right press. But you've already got to get the general press involved as well, and journalists involved to explain how we have a stake in these companies. And then, as I say, our pensions are there, other investments, and as customers, you know, we buy supermarket goods, we buy clothes, and we buy other services. Now, we have a choice. Somebody said to me the other day, every pound is a vote. So you can say to people, when they see this relational assessment, you say to people, well, if you have a choice, and I know it's a question of money, and some may not be quite as cheap as others, but if you had a choice, would you like to buy your food, say, from a supermarket that does the following things: pays suppliers on time, employs properly, keeps debt down, is a responsible member of society? Well, if you do, you might this is what this company scored against these tests. Would you like to buy your goods from that company? So we have a choice, and at the moment, supermarkets is a good example, isn't it? People go for price, basically, and people say to me, all the problems in supermarkets not paying employees enough. People say, we expect cheap food. Well, hang on, what does that mean? Do we expect cheap food at the expense of other people, obviously the growers of the food, the farmers, etc., etc.? Would you like, in your pension fund, to lose, I don't know, a penny a year on the value of a pension fund, knowing that your money's put into companies which are responsible in this way? Well, I hope I know the answer. Now, what can we do? Well, we could buy a few shares and go along to some of these AGMs I've been talking about. Go along to Tesco's AGM and say, can you confirm? They have to report on the average payment to suppliers, which means nothing, of course. Can you confirm that, first of all, what's your payment date to suppliers? They say it's all complicated because it depends on the deal we have with them. Okay, can you confirm that you pay at least on or before the due date for every supplier? What about that as a starting point? And get publicity for that. Now, I think I want a movement. I've done a one-page paper on this, a movement led by Christians, but it doesn't have to be led by Christians, it could be led by everyone. A bit like fair trade, that was started by Christians. And you know, people now come along to fair trade and say, will you please put your logo on our Cadbury cream egg or whatever it is. And they protect the growers and farmers in Africa and South America, I'm sure you know. And originally that cost more. It doesn't cost more now. The market's just accepted it. Now what I'm saying is we should be protecting all stakeholders, not just the people. There's nothing wrong with that. But we should be looking at the way to change the culture so companies work for the benefit of all stakeholders. And we have the choice where we buy goods from, the companies we invest in, the companies we work for, the companies we engage with on a day-to-day basis, people we know who work in these companies. And through that, we can transform capitalism from within. And in this extent, obviously there's different ways of achieving this, and John's spoken about other ways through MPs and so on, but this is just another way of changing corporate culture. And it would do companies a lot of good as well, because they'd be more acceptable and welcomed in society. So Theresa May said, we don't just believe in markets, but in communities. We don't just believe in individuals, but in society. Everyone has a right to take ownership of what matters in their lives. So, there are, there's a few thoughts for you.
Thank you so much, Jonathan. Thank you.